And joining me on the podcast right now, and of course, you can catch this on video, and you see Paul in his smart tie there, hair done. You always look smart, Paul. That's the thing. He's a smart investor, full-time investor, equity analyst. And
you're very polite there, Justin. It isn't what my wife and the kids say. They're so a scruffy little devil. So
yeah, but to be fair, I've only seen you from the waist up.
Yeah, okay.
I have no idea what's going on downstairs.
You don't want to know.
No, I know. But
it's a bit like the market. In fact, that's a bit like the market to go to the game in two halves as much as anything, because I have sort of like, you have a look at what's happening at the sort of top level. And obviously, the VIX is now below sort of 17, which is suggesting actually, a bit of complacency there. And it's sort of like, is it the calm before the storm? Because that has been a really quite a good, strong contrarian bet. When the VIX gets the volatility the index gets above sort of 30, it's a time to buy. And when it gets below 20 and it's currently 17, it's a time to sell. So I do wonder, but I would say sort of broad picture. I'll use an analogy that the sort of like the markets are playing a game of chess at the moment. You've got sort of like the bulls on one side playing white who are winning, and it's been sort of like the market's been sort of held up by continued consumer strength, and the bond yield curve sort of like in the Treasury is coming down, inflation expectations in the States, not the UK, coming down, and that optimistic scenario that 2024 is going to be a bit of a rebound and we're going to get a Ukraine ceasefire, which is so the white sort of winning, but black is now on the bears, which is I'm sort of as I've been sort of cautiously or reluctant bear for some time. The sort of the black pieces have got some pretty big sort of moves ahead of them, and you've got sort of like M2 money supplies we talked about, decreasing, in fact declining substantially. You've got that banking crisis, and you can see that through the senior loan officers' reports that you've got credit contraction, and you're actually starting to see sort of like inflation expectations now ticking up for the back of the year in sort of like the Michigan survey, which was from last week. So there's some pretty big forces, and my view is that this game the game of chess is going to go on for about 3 years, and black is going to lose, white's going to win, but in 2025. And I can actually see, and I did a sort of like a quick sort of like valuation of what I think the S&P will hit out, and I think they'll do $220 per share in 2024. Stick a 16 multiple on it, and you get roughly round about sort of 3,500, and it's currently 4,200. So I think there's going to be really a bit of pain, and I would say you could find, and I know it's just still psychological, but with the VIX at 17, that smacks to me is that actually we could see a turning point quite quickly, albeit the Q1, if you look at the US earnings season, the corporate earnings, it's been really strong. I don't know what you've made of it so far.
Yeah, but do you know what? It's odd. I mean, part of me thinks, put it this way, that I started investing a bit more. I was like, I think I was almost 40-50% in cash at one point. But now I went to the point where I was almost 60 or 70% invested, and I started pulling back. And I thought, I'm not convinced. Part of me has an underlying bearishness to it, and I don't think it's as simple as that. The market's just, like I said, our inflation, that's annoying me. And the UK inflation is
only
in double
10%.
Yeah, well, twice now the experts have, misforecast this. And even the Bank of England was saying it should be 9.2% by now, and it's still 10.1%. And we're the only, I think, European country in double digits still. What is going on? And I said, going back with the financial crash, you said that central banks could pretty much solve that overnight by, reassuring people, saying we're backing up the banks, we're doing this. With inflation, they can't do that. It's not an on-off switch. They can deal with it. It can last for ages. And so that's why, it will have an eroding effect, especially with interest rates higher, over a longer term, I think. And so it will be volatile for a long time. Certain companies will do okay, but but I just, this week, my perception, even last week, was very bearish. I don't know why. I don't know if it's just sometimes you can be bearish and it's completely misplaced. Another time I'm thinking, okay, let's not actually go fully invested. Let's hold back a bit with some cash here, because there could be a bumpy road ahead. So I think there will be.
What do you think is going to happen? What do you think is the Fed going to push interest rates up by a quarter point, and the Bank of England likewise, given the hotter than anticipated inflation read? Because you have core inflation in the UK at over 6%. You've got wages at 6.5%, and that is sticky. That's stripping out energy and food. That volatility. So that really is. And it isn't that much better actually in the States. I mean, you still got core, I think, of around about 4.5-5% as well. So, what's your view on interest rates?
Yeah, well, it's odd. I mean, I think they'll go with, it's almost like they don't want to scare the markets as well, but they've got to do something. They've got to stick to their path. I mean, what's the least unexpected outcome? If they said we're stopping right here, would that scare the markets or scare people or whatever? I think, do they know something? There's going to be more economic downturn happening that we know about. So I think if anything, they're going to stick with a plan of what's predicted, what's forecast. But like I said, the Bank of England have no excuse to sort of stop right now if that's the way they're going to deal with inflation, is raising interest rates, because it's not working at the moment. And with the lag effect, in fact, it may be long, but they've got to sort of stick with the plan if that's the plan they've got.
When you say you stick with the forecast, what forecast do you mean? Do you mean their forecast or the market's forecast? Because that's a big difference.
Yeah. So what's is it sort of consensus forecast?
The yield curve in the States is saying we're going to get interest rate cuts of roughly around about 75 basis points by the end of the year, which is frankly nuts in my view. But because
but that says then the reason why that would happen, isn't it, is because of bad economics. Okay, but it's job numbers going down, growth going down, and what's worrying is yes, this is worrying. If inflation is still high and you've got rising unemployment and growth going down, that's stagflation. And that is not good. That's I don't know the last time that happened is. So there is that worry. It's hard to say. Is that going to happen? Is that going to play out? Is that what we're worried about? Is it likely to play out? I don't know. It's just all this worries about, isn't it? So,
I think last week we got a really quite a big important data point, which was solidified again, early this week, because in the US we've had the banking, the results, and we've had the major banks and some of the small regionals all reporting. And what's actually been is a really much better than feared expectation, because deposits have stabilized, i.e. after the Silicon Valley Bank, you've had the big money center banks really knocking the ball out the park on net interest margin. So what that means, if you're a central banker, is that actually the coast is clear in terms of financial stability. And you're seeing sticky inflation, in fact, worse than you anticipated inflation. I just cannot see, if you're a central banker, that you're going to basically cut interest rates unless, as you rightly say, there's another big sort of black swan which happens that creates financial stability. So I actually think it's locked. Unless we see a major problem, which could well happen, because we have been pushing up, I just can't see the central bankers coming off their plan of keeping interest rates at roughly around about 5. Well, in the US, 5.5%, and in the UK, they're going to push it up as well, because the coast is clear now on the banks. It doesn't mean there won't be another problem like commercial real estate or auto loans, the cars rolling over or whatever it is, or the housing market crashing. It's unlikely, but those kind of things happening and causing problems. But given financial stability is now back, sort of okay, we've given it the all clear for the time being. That is, it's going to be higher for longer. Yeah. I just can't see any other alternative.
No, exactly. And I suppose what's the next stress point? So we've had the banks, feeling the stress. If that's largely behind us, like you say, there's other areas of the economy that could feel it really, harshly, and could take the.
Well, I'll tell you what, which is going to be okay. Is if you own large cap tech stocks that have rocketed this year, because if we're right. Okay, and let's just park this massive, great, potential black swan that we're going to get another financial instability, which there is. I do think there's more than a tail risk probability that could happen, that we're going to break something else. Yeah, but let's just assume it doesn't, and the coast is all clear, and interest rates stay higher. Well, what's going to happen? Yeah, the yield curve is going to increase. It's going to all elevate up. And we're going to get 5.5%, or there and thereabouts on sort of the 2-year. And the 10-year is going to go up from 3.6% up to around 4.5%, whatever it is, or 4.2 or something. And the big tech stocks are going to roll over because they're on an average PE of over 25. So where is the next shoe to drop? Well, if you're in the large cap, Microsoft's, Apple, just on valuation grounds, it's totally unsustainable.
Yeah, No, do you know what? That's very important. Everything comes back to value, doesn't it? At the end of the day, and you can get away with it for a while, a rally into higher levels of valuation. But that's at the moment what I'm looking at. I'm paying attention a little bit to sort of more to saying, is that cheap? So I even see stocks now, the good growth in a P of 20 or something. Yeah, it's not cheap though, is it? And
you're
so
like
I'm
me.
a little bit cautious, I know.
You're turning into a value investor. Fantastic.
Yeah, well, it's annoying because I'm thinking there'll be other opportunities out there. It's almost that the market's changed, and you've got to say, like I say, you've got to see that. I'm not going to come into that. I think that's cheap. I think that's undervalued, or it can't get a lot cheaper based on it's close to what asset values, an asset value or something, whatever. But I mean, I'm looking at that now, thinking this is silly cheap. There are some opportunities out there, but there's also some companies out there thinking that's still not cheap considering, so.
Yeah, I mean, I think when one company which is silly cheap came out with a trading update yesterday, which is CakeBox, which is the sort of the UK's go-to provider of fresh cream cakes. And I was lucky enough to interview the new CFO, Michael Botha, and the CEO, Sukhtam Dal, yesterday. And the big message, there's two big messages. First of all, they had a strong second half, and they've now gone back into like for like, shop sales growth, which is great. But the large part of that is because the consumer is now acclimatized to higher inflation rates, i.e., and you think about it, that's not actually a crazy thing to say, simply because, look at my behavior. You had that sticker shock that the energy went through the roof 9 months ago or 12 months ago, and everybody was turning their heating off and economizing and just feeling, crikey, we're in a really tough area. Now we've gone through 6 to 9 months of that. We've had enough of sort of like, running our budgets on a shoestring, etc. And we're going out, and effectively, Sue, what he basically said was that he's seeing more traffic in his shops and through his online stores, and people are spending more on cakes, even though they haven't actually pushed the prices up much at all compared to normal sort of food inflation. So that says to me is the consumer is now normalized, has become accustomed to this higher inflation, is going back to to normal behavior. And you can see that on the experiences, because the flights and the travel is really strong. You had some of the airlines already saying that they've got record bookings for the summer, and you've also seen your restaurants and your pubs very busy. They even are around here, even on a Monday and a Tuesday night. And he's seeing the same thing in his shops, and he's online. And the beauty about CakeBox is it's a franchise model. It's cash flow positive, strongly cash flow positive. It's as I say, it's capital light because the franchisees pay for the actual shop and the upkeep of the fixtures and fittings and stuff like that. And they're trading, and they've got a strong balance sheet. They've got about £6.3 million of net cash, which I think equates to around about 15p per share. You strip that out from the share price, even though the shares have gone up to about 130, it's gone up about near 5-10% since yesterday. But you strip that 15p out, and it's trading on around about sort of 10.5 times PE for a growth business, which is a franchise model, and it's got lots of opportunities. So when it comes to sort of value, that's, put it this way, if I had the choice of paying 25 times for Apple or paying 10.5 times for CakeBox, I know which one I would eat all day long.
Cake over Apple.
Yeah, exactly.
But no, did you know what? It's funny you say that. We do have this, when we have these initial shock, you get the mass media reporting on something, and then we all have shock and we pull our belts in. But after a while, even with, like the war in Ukraine, you see some still horrific things happening there. But after a while, it becomes blasé to you. It's nothing new. So you adjust to it. And that happens with us as a cost of living. You realize things have gone up. And so you rein everything in, and you realize, in fact, they have gone up, but I can still afford them. What's the point, not living life?
So, exactly. And also, you look at the strikes and stuff like that. The rail strikes. Well, it just becomes wallpaper now, doesn't it? You don't travel on the days of the strike. Simple as that. And it just loses its effect. Certainly on the sort of big shout in the news, etc. And it's not covered. In fact, we had the same thing with the pandemic, didn't we? In terms of once we'd actually got the vaccine, they started taking off all the stats, and it just became noise. noise, as in like, people were less concerned about it. I mean, it was obviously, it's a background, but as you say, you just become accustomed to it. So I think that's the sort of key takeaway, for investors, is if you're in an area such that is sort of like, affordable treat for people, and they want to go out and do it, and it's a value service, then they're going to continue, whether that's restaurants, whether it's travel for the holiday, whether it's, sort of like going into, sort of cake boxes shops and buying and spending a bit of money on a birthday cake or a celebration cake that they're doing. And so that's one thing which is important for investors, that they get that climatization. But the other thing is you're also seeing quite a differentiation, a polarization between the stocks that are doing well, which do have these brands and do have the service, the quality stocks, and actually companies which are performing poorly, because you see a lot of the pure online boys who are listed, in 2020 and 2021. They're still struggling like anything. I mean, if you actually look at some of their models, they're still seeing quite big decreases. So you are getting a lot of polarization. But if you're a stock picker, that's pretty good, because what it means is you've got this overlay of good valuation, strong balance sheet, secular growth, and you're getting it at rock bottom prices. So there is a nice bit of sort of like upside there if you look at past sort of the next 3 to 6 months.
Yeah, well, do you know what? Talking about experiences. That's why I still hold sort of XP Factory. I mean, I've seen that.
Yes,
it's always been full. I did a friend of mine actually trying to. Went into town trying to get in there. Someone just went into town just trying to get on the off chance and getting into Boom Battle Bar. Couldn't do it, fully booked out. And I think
it's great.
There's a certain level of, and they are targeting that area. The young people sort of, don't
experience,
really
isn't it?
Yeah, they don't have mortgage payments and all this stuff. They don't know all that. They don't pay the utility bills. And I mean, they are like 30 million market cap. They're expected to do about 40 million in revenue this year, and about 6 million EBITDA. Adjusted pre-tax profit of 2.3, I think. And the growth is going to continue. But yet, because of sentiment, everyone's worried about the cost of living. Just go along to one of their bars and see how busy they are. Yeah. You realize there's no cost of living worry there at all. So, it sometimes, there's opportunities just because the sentiment have knocked these things down. And
I think it's a best-in-class operator with something that consumers want and go out and enjoy. And they're doing it. And as you say, it's difficult to get in. I mean, another one in that consumer space was basically they came out with a trading update year end was Supreme, and I talked about this last time, which is basically about 50% of the business, or in sales terms, is vaping, which is their 8.8 vape ban, but it actually generates about 2/3 of its gross profit. And then the other divisions are batteries, lighting, sports nutrition, and a bit of some other FMCG brands, etc. But their vaping brand from the trading update is absolutely flying. I mean, it went up like 75% year on year last year, driven by sort of a bit of M&A but a lot of organic growth. And as I say, this is the highest gross margin part of their business. And they just had a really strong standout second half, generating a huge amount of cash. And they're only slightly sort of like, net debt, etc. I think the net debt's about 0.3 of EBITDA, etc. But the shares have gone up about 10% since the trading update. In fact, they're up about 20% since I talked about them to you only 2 weeks ago. So, they've done pretty well. But even at current levels, they're still trading at 10.5 times, sort of like, price earnings ratio, and, generating a lot of cash. So, you just can't escape that. And the thing that people miss in terms of, sort of vaping, etc., they sort of get hung up in terms of, is this healthy and all this sort of stuff. Well, actually, let's just look at the facts. Yeah. The NHS, I think about 7 days ago, announced that it was giving out 1 million vaping starter kits to, smokers to get them off, because it's the most effective way to get smokers to quit. In fact, it's twice as effective as using sort of like, tobacco, sort of like nicotine patches and gums and stuff like that than anything else. And so, when it comes down to when the rubber hits the road, is this something that is helping, reduce the number of lung cancer patients? The answer to that is yes. Is it reducing the cost to the NHS? Yes, massively. And that's why they're giving out 1 million of these free these starter kits, because it's proved to be effective to get people out. So, And I actually think vaping is actually less. Okay. I mean, you don't have any cancerous tobacco or anything like that. That's absolutely convinced of that. That's medically proven. But when it comes to sort of, I think it's more healthy than alcohol. If you've got somebody if you're a person who's overeating or drinking too much, you're going to cause yourself a shed load more problems than you are if you do a bit of vaping. And you don't get any benefits for overeating or drinking, but you do get benefits from vaping if you're a smoker, and not 95%, in fact almost 100% in lots of cases of people who vape are smokers, because there aren't that many people who just vape who've never smoked. Most of them are smokers. I mean, I don't vape because basically I don't need to.
Yeah, there's two sides to it, isn't there? The controversy. First of all, they said without doubt it's better alternative than smoking cigarettes, because you've got the tar and of course the carcinogens. And yes, people should be pushed onto that, definitely, because that's a tar damage your lungs. But there's the worry about, I suppose, kids as a fad taking it up as a hobby, never previously. So that should be discouraged. If you've never smoked before, you shouldn't have taken it as a fad or hobby.
That's very small.
Nicotine, that's
very
nicotine.
Small. They did a big. The government ran a big survey. I mean, a massive, sort of nationwide survey in 2021. So only 2 years ago, looking at, who actually vaped. Yeah. And what it said for adults, i.e. people over 16 and above, over 99% were previous smokers who vaped. Okay. So there was only 1% who had not smoked before. And when they looked at 11 to 15-year-old, 98% of 15 to 11-year-olds who vaped were previous smokers. So, yes, I mean, you could say, okay, it's increased marginally since then because the vaping market has increased. But actually, we're still talking, undoubtedly, just from the stats, the hard numbers that the government has produced, undoubtedly, the vast, vast majority of people who vape have or would have smoked, because we were kids and stuff. I mean, crikey. I mean, I never avoided smoking.
I remember it's like Alka Pops. Trouble is with vapes, they're all very bright and they're all very attractive. It's like Alka Pops back in the day, wasn't it? You're trying to attract, younger people. Yeah. So maybe you should just change that in some ways and not make it so...
No, but just push yourself when you were a kid, when you were growing up. How many of your mates and girlfriends and stuff like smoked? There was masses. And the reason is because it's basically trendy, And so consequently, the people who have vaped generally are almost certainly were or have or are smokers. And it just is like, because they're going to do it. And if you're giving them alternative, which is not killing them or killing other people in passive smoking, it's got to be a benefit. And that's what the NHS and the government have said, last week. I mean, it's
well, do you know what? I caught my son he's 13 with a vape, right? I said, first of all, it's illegal. You're not allowed to do it. And I thought back, I gave him a real big row on it, saying nicotine is highly addictive. You don't want to get involved in that. And I realised back in the day, I was actually doing that with cigarettes, probably.
Yeah, exactly.
They're a lot worse,
Exactly.
So I know it's a thing you go through, but I did say, they can be addictive. Don't start it. And it's very good for ex-smokers who are trying to come off. But it's not much starting as a hobby, Fred. I suggest basketball or something else. And
then you just look at it, say top picture. They're both Cake Box and Supreme consumer brands, growing well, strong, good, decent pricing power of their own brands. And they're basically trading at 10 to 10.5p PE when you strip out the cash. I mean, and they're generating lots of money. So it seems for me those kind of things are no-brainers if you compare it to sort of big cap tech or anything. Those are safe areas that if we go through a hard recession, because they're affordable treats or value conscious brands in the case of Supreme, that in a downturn they're actually going to do pretty well.
Yeah.
And
well, it's one of bigger caps because it's struggling to break above a certain level on the chart. Moneysupermarket, but
yes,
but they had a good update. I mean, even looking at, let me get it up here. But even
my dad loves it. My dad loves it. He's chatting to me every week about Moneysupermarket. He's made some good money on it already.
Yeah, exactly. Look at this. This is Q1. This is versus last year's Q1. Insurance up like 23%. Money up 9%. Home services, which are energy, which of course largely flat, but it's up 5%. Travel up 63%. But overall, up 15% on last year, so it's decent. They say, once energy kicks back in, that's really going to stoke it up. But they're very confident of hitting their figures, which is, they say, EBITDA region of around about 124 million, which would put them in 10 times EBITDA, pretty much. So, and decent dividend, So I think that once that energy market kicks in, it's going to give it like the second boosters kind of thing.
I think you're right. I'm sort of like. And the reason why I sold it was as much as because I was worried at the time that the energy was going away and wouldn't be, because it was Liz Truss who was going to be keeping it the prices sort of nailed down for like 3 years. And obviously you had that Amazon saying that they were going to launch a price comparison site, and that's come to nothing, So because they've got bigger problems, Amazon, they're reducing costs. Never, they don't want to start something else and have another big sort of like investment they're going to have to make in a price comparison site. So I think I made a bum call on that one, to be honest. But hey, it's one of those. I made lots of. At least it was a bum call, and I made some money, so that was not.
Exactly. Exactly. A bum call and losing lots of money is a different thing. I know, it's fine. I know it's a different kind of missing out. I know, but there we are.
Another one which has got rocket boosters in it is Argentex. And I own the shares, and I almost bought some more actually this week, because they crazily went down after the positive trading update, etc. And factually, sorry, it was a full year results, but they gave us a trading update for Q1, and the sales there were up 34% like for like, absolutely storming. And again, they've got a shed load of cash, sort of 22p per share, currently trading at roughly around about 115. You strip out the cash, and I think the PE comes down. You say it's about 10.3 when I calculated it last. I mean, just a ridiculously good value, generating about 12%, free cash flow yield. And so this is absolutely minting money. Got lots of growth opportunities in terms of, overseas with Holland. And I interviewed the guys there, and the CEO, Harry Adams. I mean, he was really excited about, the opportunity in Europe, because it's enormous given their bench strength they have, in the UK, and they're growing it in, over in Europe. And there was also, which was really interesting, great bit of insight. And I suggest people have a look at it if they haven't done. They had the CTO on there, the technology guy, and he was really talking up, talking about how they're going to, improve and release additional versions of their software, their technology, to give sort of like multi-currency IBAN accounts and all this sort of stuff across the world. So again, that's just dropped through to the bottom line. So I know the shares, it's just bizarre. The shares went down on the news. Why? I really don't know. I think it's just some people wanting to exit, tidy up their position, or selling into high liquidity. I'm not sure, but I was very close to buying some more shares, because with a 12% cash flow yield, 10 times or 10.5 times PE multiple, plus this is on relatively depressed earnings, because 2023 is still the investment phase, but 2024, 2025 is going to see a major uplift. And I wouldn't be surprised if somebody bought these out as well, because they really are demonstrating strong momentum in the business. 34% top line growth. How can anybody complain about that?
Yeah, the margins are very good. It probably went down a bit, but the chart is odd, and it's hit some resistance there. And so it's looking like it may need to go, because it's risen. Let's be honest, the performance has been done very well. It's back in July, for example, last year it was like 72 pence, and it doubled to 140. And so you may see that profit taken, and you may just have to go sideways for a while. But in that time, of course, the business can improve. Like you said, they've spent investing.
Yeah. You raise a very good point. This is something that investors should take away as a principle elsewhere. Yeah, you can have instances where the share price goes down, but the intrinsic value of the business goes up, and that's what happened. Because you look at they're knocking the ball out the park. My valuation has gone up, and Singer's ticked up from about 180 to now they're at £2 per share, and I can absolutely understand that, because the business is such it's got a rock solid balance sheet. 22 pence per share. Of just net cash on the business, and it's generating a shed load of cash. and investing for growth. And we know that whole sector's doing well because you just look at Equals and that's doing similarly. I mean, it had a fantastic first similar sort of growth, I think, in Q1. So it isn't as though it's a one-off outlier. I mean, this whole sector is absolutely flying. They're winning, hand over fist market share from the traditional banks. And you can understand why, because the banks have just had a bit of a shock. They're probably pulling back some of their technology investment in terms of what they're going to put into, their Forex trading platforms, etc. They're going to really struggle to keep up with these guys. And as I say, and the smaller sort of operators, because the bar in terms of compliance has gone up, then the competition is going to be decreasing at that area. So I actually think that there's going to be a fewer number of quality survivors, and Argentex is going to be right up there. And Equals, and as I say, if the shares carry on going down, I'm going to be mopping up. I tell you, putting some of my cash. How much cash have you got now? That in your portfolio? I think you had about 40-45% last time.
No, it went down to about 30%. It's gone back up to 38. It's around about so it's close to 40%. Yeah.
Okay, we're about both about the same then.
I've invested a little bit, a tiny little bit. I mean, I don't know if you saw the results last week from Good Energy. Now I've been watching them for a while, but they've changed the business model. The founder and CEO is now gone. There's a new CEO in there, and they're aiming towards a more high margin sort of energy business. And they've
what's the principle of Good Energy? What's their USP? Well,
they've got about 277,000 customers.
Which type? Sort of, are they consumer business?
Yeah, but both. They've got 1,700 independent suppliers of energy to them. They sell it back into the grid and all that stuff. And they're now going into heat pumps and all this stuff. But they did own sort of wind farms. They sold that. It was a lot of debt with that. They cleared off the debt. Is
the idea of Good Energy to be zero carbon electricity?
Yeah, pretty much. The community completely believe in that. Like you said, they've got one of the lowest cost, acquisition customers around, because they're really bought into this model of, 100% renewable energy, and they can sort of, fix up solar panels and all the heat pumps to these customers at very low acquisition. Like I said, they've got 277,000 customers. They are the second, I think, although the first biggest, the biggest lead independent in feed. I'll go here. They are the second, largest feed-in tariff operator in the UK, highest profitability customer in the industry. Now they sold this, like I said, wind farm business. So now they've got 24 million quid in cash. I think about 4 million is restricted. They've also owned 49% of ZapMap, which is the largest EV charging map in the UK, which you can set up with subscriptions. You can pay through that. That's and together those are way above their market cap. Their market cap is like 35 million, and they're profitable last year. So I just think at the moment they've got 19 million in cash, and they're looking towards higher margin businesses, and they are profitable. I think the profit before tax in the period was about 3.1. In fact, it was a lot more than that with the profit with the ZapMap realized value. But so 3.1 with EBITDA 4.4, and yet like I said, they are. The turnover was, due to wholesale prices, was 248 million last year. But what I quite like is that they are growing them. All they need to do is improve those margins, and they are heading towards that. Like I said, they had a lot of debt, got rid of the debt, they got lots of cash, lots of time, and the valuation is just based on cash and ZapMap. Basically, it's nothing else.
Have you spoken to the company yet?
Yeah, I'm hoping to. Yeah, speak to the CEO very soon. And,
right, good. Okay, well, we have to report back here how you go, because I'll be interested in that. Sounds like a pretty interesting sort of USP differentiating model there.
Yeah, and if you look at the whole ethos, they're very into that. In fact, the founder, I think it was Julian, but set it up years ago. She's way ahead of it by saying renewable energy, a community of people, and like I said, they're into this about 1,700 independent suppliers, all that stuff, and they are into this a lot. But now they've sort of just changed the business model a little bit to be more profitable, higher margins, and less debt, which I quite like. I always liked them before, but I thought they had a bit of debt. Now that debt's largely cleared off pretty much, and they got a ton load of cash, profitable. And like I said, where are they? 35 million market cap, something ridiculous. So
there's lots of small. I think again that's another sort of important takeaway, and we've had plenty of them today. But you go at the top end, the really mega cap, and it's expensive. But Actually, I was looking at the sort of like, the indices, and we've had overall equities, got the S&P 500 up sort of 8%. You've had NASDAQ up 17% this year. But actually, when you look at AIM small, just the AIM index, it's flat to negative actually this year so far. And so what that says to me is that we entered the year with real bargain territories, and actually we're still at bargain territories. And you can see that just through the numbers, what you've just talked about from, good energy, looks to be cheap for a growing stock. And the same thing with, sort of like Supreme, Argentex, and CBOX. So it comes down to it comes down to that game of chess as I was talking about. Yeah, who's going to win it? White is going to win it. The bulls are going to win eventually. It all depends on how strong counter moves the bears with the black are going to put with this, contraction in corporate, and what your time horizons are. Because if you're short-term sensitive in terms of your portfolio, then you probably want to stay cautious and have a lot of cash. But actually, if you're prepared to take a longer-term view and sort of like trade through the volatility, by 2025, 2026, we should see a really good sort of like, outcome for a lot of these stocks that are best in class and trading at retractive valuations.
Yeah, isn't it? So I'm just looking at the broker forecast here, and there's a Canaccord it is, and they've got on Good Energy 475 pence target, and that's based on a 6.4 times EV/EBITDA for 2024 and 4.7 for 2025 So it's
and what's his share price now?
It's at 222.
Okay, so that's about 100% upside or something.
Yeah. And I just think it's almost like that. How low can companies go when you got like 24 million in cash? Your market cap is 35 million, and your investment value in ZapMap is valued again is double that. So it's just nuts. So you can't go a lot lower. I don't think it's just
let's be clear about it. How that is a great question. I love that. How low can things go? And we know they can go flipping low. You just look at, we've had Verici, which went down to about 6 or 5p and is now at 13, which is like only the last month. We've had Saeta, which went down to like mid-20s and it's currently trading at about 60p. I mean, it just shows you in the small cap land, you do get silly valuations, don't you? I mean, you just, it isn't so much how low can it go, it's how silly that we can get it. And it can go very silly.
Yeah, and I would say as well, don't go big on anything because it can get silly. I mean, I mentioned, Destiny Pharma just before, and saying how ridiculous the 3 independent brokers there have an average valuation of £2.80 a share. They're now 32 pence. Now they were like 180 a year ago. This is before they had one asset back then. They didn't have a deal on it. They were going through phase 2 trials.
Yeah.
And they're approaching phase 2 trials. And now they've gone through phase 2 trials on both assets. They've got a deal on one. They've got a deal coming up with another one. A rest of the world deal on the first asset they've done a deal with America of. And it's like at 32 pence a share. They were like 6 times higher than this, like 12 months back, and they weren't as advanced. So, and they got cash. So it doesn't. Yeah, there's a lot of stuff out there. I mean, in fact, Saeta and all that was sold off massively. Verici, and like I said, some of those were like Verici was at cash levels, and I think.
Yeah, I know, absolutely. Yeah, no, it was absolutely nuts. Yeah. Another company that came out with a sort of like an update was again Avacta, and I think they've got their prelims next week. But they said a couple of days ago, or was it 3 days ago? I can't remember. But their second lead candidate for their precision platform, their AVA 3996, is now just been presented at the world's biggest international cancer conference out in Florida, which says to me that they're pretty damn confident in terms of the preclinical data that they're getting. And the difference, but they've got two major sort of like drug targets in the precision at the moment in sort of either preclinical or clinical. You've got the AVA 6000, which is the doxorubicin, which is currently going through at phase 1A trials to basically establish a maximum tolerated dose and then the optimum tolerated dose in other ones. So that's making really, but the data that as I say, it all works off the same sort of like technology, which is this effectively FAP activated chemo warhead release into hard tumors. But the doxorubicin essentially freezes or cancels out and stops a tumor growing, whereas the AVA 3996, this second candidate, absolutely zaps a hard tumor. It's demonstrated that the actual active chemo warhead I mean, it's so toxic on its own that it's hardly ever used. But if it's got this if it's got this precision technology, it can be used safely, and they've seen that in preclinical trials. With animals, with mice, etc. And if that comes, then it'll zap tube. It was actually you'll be clear of tubes. You may not even need surgery either. So that's a really big a booster, because it means that they've got different candidates all going through using the same technology. So if one works, they should all work. And they hit the we can stop growth and we can get rid of it if it's a real problem. So yeah, I think it was really, very, very positive. Anyway, as I say, we've got big news flow coming out next week in terms of their prelims. But I think it's this the R&D technology they have there under the bonnet in terms of their precision platform is top notch. In fact, their other side of the growth platform, the Pharma platform as well, is doing really well in terms of its third-party royalties, its own sort of diagnostics. So we'll hear more next week. But I thought it was worth pointing out to investors, because you don't go to the world's biggest cancer or oncology conference and out in Florida and present something unless you're pretty confident that you basically, because you get the world's biggest and most known key opinion leaders, plus doctors, physicians, industry experts, who then mark the card and will be watching it. And therefore, you've got to be pretty confident when you sort of like raise the awareness that this is going to work. And I think it's anecdotally, I think that's great.
Yeah. You can't just go there and wing it.
You're just going to look an idiot, aren't you? It's going to damage your brand. It's going to damage the technology if you just decide to rock up there and haven't got proper data, because it will fall through and it will be game over. But I think people can take a lot of reassurance from that.
Cool. Any other stocks you've been looking at?
No. How's your portfolio?
Where are you at cash-wise?
Yeah, I'm about the same as you. I've just, as I mentioned, I had the big dump of cash from Kreshchik in February, but then last week I got a big dump of US dollars from Amrit Pharma, which got paid out. I've now got about 40% cash I'm looking to deploy. And it's the same sort of, I'm not going to go, immediately just buying. I'm just going to sort of slowly drip feed stuff into the market over 3 to 9 months. And really the investment strategy is staying the same. I'm looking ideally for technology or healthcare, good pricing power, lots of IP, strong, ideally a strong balance sheet. Well, will be a strong balance sheet, and just take my time on it. I mean, I think there's lots. I mean, my stock watch list is enormous. I mean, it really is. I could buy lots and lots of stocks, but I just want to sort of take my time. And ideally, if I can go into the areas that I want to, and let's be clear about it, my risk tolerance is different to a lot of people's. I mean, I have a lot of volatility, so my risk tolerance is very high, and my investment time horizons is longer than most people, i.e. it's sort of 3, 5, 7 years. I mean, that's what I sort of bigger hold on. People they don't have the same sort of objectives as I do, to so much as anything. I mean, I've done very well over 23 years in my returns. I'm delighted, but let's be clear about it. I've had lots of sleepless nights and lots of volatility, and I wouldn't always wish that on other people, because it can be painful.
Yeah, I know. It's almost like when I've had that with stocks where I've had such a big position in it. You're looking to every angle, every bit of news coming out, and you're thinking, I don't want to be like that. So
you get battered, don't you? You get worn down by it.
Yeah, exactly. Any tick down in the stock, beyond 2, 3, 4, 5%, you think, oh no, and you think, oh, selling begets selling, it's going to go down further. Yeah, so you want to be at the level where it doesn't matter if a stock drops off 10% or something, because it doesn't affect your portfolio that much. If it does, and a 10% drop really knocks your portfolio, you're probably overexposed.
Hey, well, I mean, one where I am overexposed, I mean, I would say is, it's equals, and I can't remember exactly how much it is, but it's a good 22% of my portfolio. I think I'd have to have a look at it exactly, but I know it's in the 20s. It's a big position because it's done well, but I still believe in the guys. And if that goes down, then it's going to knock my portfolio to a big hole. But I've been through those before, and you know, it doesn't. It's just that most investors probably don't want to have that position size as big as I've got it, you know, and I wouldn't wish it on people, but you've got to, as I say, I think I've mentioned it before. You only know your risk tolerance when you blow through it. That's when you know it, because then it causes you so much pain.
Feeling. Yeah, I know what you mean. Yeah, exactly.
And it gets bigger as you get older.
I know. Yeah, I know. You know what? At the moment, I've got nothing over like 8%.
Oh, okay. Well, you kept yourself pretty on a firm leash there, haven't you?
Well, that's it. I think at the moment, I'm just my initial investment. I just go quite small on, and I think, okay, let's see. You know, if I'm right or wrong. If I'm wrong, at least, or temporarily wrong, you know, then at least it's not going to knock my portfolio value too much. And if it starts to go right, maybe you know, I'll average up a bit and put a bit more in. But yeah, just sick of the last 18 months of just sitting on a big paper loss or losses and just thinking, I've had enough of that.
Yeah.
You know, and I don't know how long it's going to go for. You know, I don't think it's going to. The market's not going to change like it did in the great financial crash. It was 2 years, of course, but I mean, we're now at what? Over 560 days since the high on AIM. That's a long time. 560 days. We're coming to even longer than the average, you know, bear market here. So, but I don't know if it's going to be. I think it's going to be one of those rangy things. You see certain stocks like rallying, microcaps, the moment going nuts, and then they'll come back down. And yeah,
I would go back to the very first thing we talked about. The VIX at 17, that smacks to me is that we're going to have a sell-off in the next few weeks. It's just too damn low. I mean, I just don't feel safe with that. It's basically saying everybody's on the same boat, on the same side of the boat, that the market is essentially, you've got your professionals who have all universally said, actually, the fundamentals don't stack up as we look at it on a probability basis to where the prices are. So they've exited the market, but you've had basically investors or passives or whatever it is coming up, taking up that slack and creating effectively a fake level of, you know, sort of like calmness on the market. It's 17 times VIX is if you chart it, you know, alongside the S&P 500, it is by far and away the best indicator of counter-cyclical, you know, sort of movement, i.e. 17 traditionally says sell, 30 says buy, and 17 is just too low to me.
Well, do you know what? I'm looking at it now, and oddly, we are at the lowest we've been since going back in January, and it went a bit lower in October, and October's were the lows.
Yeah.
So, and it's like it's heading down towards that low. So there may be a bit of a sell-off happening. You're right there. So
it just smells. It smells complacency to me.
Batten down the hatches, sell everything.
No. I'm trading through it. I'm not selling. Don't get me wrong.
Yeah, just don't get complacent. Don't go crazy and think there's a new bull market starting.
I just think we just need to be prepared for the next 3 or 4. Get us through this earnings season. But my instinct is saying earnings season, higher inflation, Fed tightening, Bank of England tightening. Until we get, I think the Bank of England's mid-March. I would say the next month, and given where the VIX is, we're going to get volatility. I just cannot see it, not perfectly honest, but I could be wrong. If we get a ceasefire in Ukraine, well, flipping hell, game's on again, you know.
Yeah, when is that going to happen? Right, marvellous stuff. Cheers,
Take care.
Paul.
Cheers and bye.
Bye-bye.